Everyone keeps asking me the same question. Is the Ottawa housing market finally turning the corner? The short answer, not quite yet. RBC's latest national housing outlook says Canada's fall market is subdued and uneven. But here's the twist. Ottawa is proving to be one of the country's most stable market, quietly balanced and setting the stage for what could be a gradual comeback in 2026. Today, we're breaking down RBC's new fall housing forecast along with Ottawa Real Estate Board statistics to show you where Ottawa's market actually stands and what we can expect as we head into 2026. Let's start with the national picture. RBC says this fall's housing market is off to a low-key start. Sales are mixed, a little stronger in Toronto and Winnipeg, but down in major cities like Ottawa, Vancouver, and Calgary. It's not a crash by any stretch. Don't worry. It's not a rebound though. It's a slow normalization. Buyers have more options, but they're not in a hurry to make a move. They're more cautious. As you'll see here, RBC's economists are pointing out three major reasons. Number one, ownership costs remain near record highs, even after the rate cut back on September 17th. Number two, the job market is softening slightly, especially in Ottawa. And number three, investors across Canada are expanding, giving buyers more leverage and time. So yes, demand is cautious, but it's also quietly rebuilding behind the scenes. Now let's zoom in micro level right here to Ottawa. According to Ottawa Real Estate Board statistics, there were 1,089 homes sold in September, down from August and July. But this is totally normal for the end of summer. Year to date, we're at 11,025 sales. This is up almost 4% from last year. That's stability, not a slowdown. The average sale price came in at $690,397. This is up slightly, about 0.3% year over year. So even as activity cools, Ottawa's pricing base hasn't budged at all. That's what a resilient market looks like, and that's what we're in right now in Ottawa. Active listings have climbed again, up to 4,388. That's nearly 20% from last year and roughly 22% above Ottawa's 5-year average. That sounds like a big jump, but it's actually a healthy correction after years of undersupply, like coming out of this post-COVID market, 2020, 21, 22, when the market was just upside down. The months of inventory right now is 4.0. This is up from 3.2 months in August. So what that means in normal language is we're in a balanced market. It's neither a buyer's market nor a seller's market. It's at fair equilibrium. The months of inventory hit 4.0. This is strange, and this is something we haven't seen in a while, but it's healthy. If we look back at the COVID days when it was just a complete seller's market, there was around 1 month of inventory. What that means is all of the current homes on the market would get bought up each month and new property would come on. Well, now we have 4 months of inventory. This means it's a balanced market. There's an equal amount of buyers as there is sellers on the market. Months of inventory, just fun fact, is like the barometer that most of us professional realtors and other economists use to give visibility into how healthy a market is at a given point. Taking a closer look at the MLS Home Price Index benchmark, we're sitting at $627,200. This is a mild 1.1 increase from last year. Let's break it down by segment. So the average single family home in Ottawa right now is $697,200, up 1%. Townhomes up 7.8%, coming in at $462,800. And condos are seeing a dip, down 1.7%. The average price of a condominium right now in Ottawa is $408,200. As you can see by those three segments, townhomes are carrying the whole load right now. It's really Ottawa's stability, the missing middle, as we call it. Condos remain soft, especially in the downtown Byward market core. There's just an oversupply right now in there, leaving a lot of opportunity for savvy buyers. Back on September 17th, the Bank of Canada trimmed its key overnight lending rate by 0.25%, down to 2.5%. RBC calls it an important confidence signal, not a game changer. For Ottawa, that small cut lands in a market already balanced. Inventory is up, Demand is steady and prices are just level and stable at this point. It's like giving the market a little bit of breathing room as we head into the winter months. So what does that all add up to? Well, Ottawa's fall market is holding its ground. Sales are slightly down month to month, but still above 2024 levels. Good to note. Prices haven't cracked at all. Even as listings rise, that tells us demand is steady, not speculative, but real. Ottawa Real Estate Board sums it up perfectly. Ottawa's market reflects balance and resilience. It's not flashy, but it's stable. And that's a very good thing right now in Ottawa if you're a consumer. Here's where things get interesting though. RBC says Canada's housing recovery will stay slow, choppy, and regionally split through 2025, with momentum returning gradually in 2026. And Ottawa's data fits that pattern exactly. We're balanced right now. We're not booming, but as rates ease and confidence starts to build, Ottawa's fundamentals, stable employment, healthy immigration, and a relatively affordable price base compared to, Vancouver, Toronto, or Montreal sets us up early for success as we rebound back into 2026. So what the numbers are pointing to, sales growth. RBC expects a modest rebound in transactions starting mid-2026. So as we head into the spring of 2026, more first-time home buyers will be re-entering the market. Price growth. Expect 1 to 3% gains next year. Gradual, not explosive. And inventory. This will likely remain elevated through the spring as we tighten again by next fall as confidence starts to build. And last, affordability. Still stretched, but improving slightly with income growth and easier borrowing costs. It's not the return of the 2021 COVID frenzy. However, it's a slow rebuild built on fundamentals, not FOMO, fear of missing out. Ottawa's market doesn't swing like a pendulum like Toronto or Vancouver back and forth because our base is driven by real demand, families, downsizers, and federal employment stability. Even in this cooling cycle, year-to-date prices are still up nearly 3% from 2024. As population growth steadies, we'll likely see demand concentrate in the middle segment like townhomes, bungalows, and small detached homes in established communities. That's where the price recovery begins. In 2026, expect Ottawa to lead Ontario, return to normal, not with a boom, but with steady, confident-based growth. You can already feel the tone shifting. Less panic, more patience. I'm out every day working with clients, both buying and selling, and there's just a renewed sense of confidence in the market as we head into the fall and look at 2026. Homes are staying on the market longer. Our average days on market is around 33 days. It used to be around 21 to 23. So homes are staying on for a longer time, giving buyers more time to really carefully look at the property, do their due diligence to make sure that they are moving on the right property so it makes sense for them and their family. That's what a real market reset looks like. This is normal, everyone. It just might feel different based upon what you're hearing or reading in the media. So is the worst over for Ottawa's housing market? Well, we're getting there. The pandemic phase is behind us. The stability is here, and the next phase is 2026. It's all about confidence and affordability and smart positioning. The buyers and sellers I'm working with right now are being cautious but calculated, and that's what I would recommend for you. Ottawa is not crashing. It's normalizing, and that normalization is exactly what healthy markets are built on. And if you want a quick breakdown on how these numbers play into your own neighborhood, drop a comment below or reach out. I'll walk you through it. Before you go, be sure to check out my next video right here where I break down my 2026 forecast prediction, what buyers and sellers should really expect next year.